There is perhaps no one better and more pertinent to deliver our conclave's keynote than Sri N.S. Vishwanathan, a career central banker. Sri Vishwanathan joined the Reserve Bank of India in 1981 as a direct recruit officer and retired as Deputy Governor in March 2020. During his nearly 4 decades of service in the RBI, he has had exposures to core central banking and administrative functions. Mr. Vishwanathan has also been a part of several domestic organizations, most notably non-executive member of the Board of Directors of the Securities and Exchange Board of India, that is SEBI. He was also member chairman of several working groups and committees constituted by the Government of India and the Reserve Bank of India. As Deputy Governor, he has handled banking, non-banking, cooperative banking regulation and supervision, besides several other functions, including internal governance, internal control, and risk monitoring. It is my honor and pleasure to now invite Mr. Sri N.S. Vishwanathan to deliver our keynote address.
Thank you, Mr. Vedant. Thank you, Mr. Ramraj. And I see a lot of my friends, people whom I know, whom I used to share dice with in this, and I'm sure that we'll have an interesting set of discussions and deliberations going forward. Let me, of course, at the outset, thank Impact Investors Council for giving me this opportunity to deliver this keynote address at this conclave, which is named Impact NBFCs Conclave. NBFCs play a very vital role in the financial system of any country, and more so in a country like India, where they further the whole agenda of financial inclusion, and that's exactly where the Impact NBFCs play a vital role. So, and this has been acknowledged in very, very unequivocal terms by the Reserve Bank of India. And I'm just quoting from the latest report on trend and progress of banking in India. And it says, I'm just quote, the NBFCs have a competitive edge in their superior understanding of regional dynamics, well-developed collection systems, and personalized services in the drive to expand financial inclusion in India. Lower transaction costs, quick decision-making, customer orientation, and prompt provision of services have typically differentiated NBFCs from banks. The reach and the last mile advantages of NBFCs have empowered them with agility, innovation, and a cutting edge in providing formal financial services to underbanked and unserved sections of the society. And I think if you look at the report, the Impact NBFCs report, it's talking of NBFCs primarily in this area, and which are, of course, with an AUM of less than 5,000 crores. Of course, in India, the NBFCs, except those which were legacy ones prior to 1998, they are not allowed to accept public deposits, and that's across NBFCs, whether they are in the impact segment or not, whether they are in the MFI business or not, because MFIs, as per the report, is part of the impact NBFCs. But I think the focus of this impact NBFC report is on the non-MFI NBFCs, because there are certain regulatory provisions for the MFIs. Now, because of this non-availability of access to public deposits, the NBFCs in general, other than those which they are allowed to take public deposits, and I can tell you, even for those entities, public deposits are a very small source of their funding, depend on market and other financial institutions. And those which can access the markets are generally those which are relatively larger, better rated, and so they are able to issue their bonds. Otherwise, the NBFCs generally access funds from banks, other financial institutions, and in fact, some of them borrow from other NBFCs themselves. In the NBFC regulatory framework was catapulted to center stage in 1998 when the RBI Act was amended to enable RBI to regulate these entities more closely. And at that time, the minimum capital requirement was fixed at ₹2 crores. Over a period of time, while in 1998 it may not have been very small, over a period of time, that was a very small amount, and we could see a fair amount of proliferation of NBFCs. Despite a record number of cancellations in 2021, close to 1,000 odd NBFCs. As of September 30, 2021, we had 9,680 NBFCs, still registered and functioning in India under the RBI's supervised regulatory framework. The regulation and supervision of NBFCs are generally guided by the principle of systemic stability, concerns, and customer protection, and which is why the whole approach of the regulatory framework was looking at, of course, when you had the rules with regard to conduct of business, code of conduct, etc. But otherwise, the focus was on the larger NBFCs, the failure of which could in turn have systemic stability implications. Even so, many of the larger NBFCs, which were much larger than banks, did not have as stringent a regulatory framework as banks were subjected to. And for example, one of the major areas where this distinction was in place when until recently was, for example, regard to liquidity management. The thought process at the time was that unlike a deposit-taking NBFC bank, where on particular demand deposit-taking banks, but there could be a drain on deposits, and NBFC did not face that kind of a problem, and therefore the liquidity framework accelerated and became a lot more loose than what you have to stringent ones for the banks. But the failure of one of the larger NBFCs to meet its obligations to the market created a huge crisis and kind of underscored the need for tighter liquidity framework for the beginning for the NBFCs, particularly the larger ones. So the approach of the Reserve Bank over several decades has been to look at it from a scale-based regulation, even if though the scales are different, number one. And they were also entity-based. So you had MFI-related regulations, you had a loan NBFC regulation, you had a what you call investment NBFC regulation, asset NBFC regulation. So each of them was entity-based, and they had different criteria in terms of how their balance sheets should be composed, and there were minor and sometimes major distinctions in the regulatory framework. What it did is that it made an integrated approach to regulation, and the overall growth of the NBFC sector was impacted because if one migrated from one type of entity to another, the regulatory framework changes. And if they went back, it will again go back. So the balance sheet or the AUM growth had to be in conformity with the composition that was prescribed for that kind of an NBFC. So obviously the move globally and also in India was to move towards what you call as activity-based regulation rather than entity-based regulation. And the first step in the direction was taken when the loan companies and list companies were brought under a single framework. Second, the MFIs were seen as another set of NBFCs because exposed banks lending to MFIs was part of their priority sector lending exposures, and that kind of provided access to them for bank funds much easily than other NBFCs. Of course, during the pandemic period, and in fact after the liquidity crisis caused by failure of one of the larger NBFCs, the RBI took several steps to ensure flow of funds to NBFC sector, accelerated and intensified in the post-pandemic during the pandemic time, because NBFCs do play a critical role in providing credit to those segments of the society which were relatively more impacted by the COVID than others. And as a result, the priority sector lending categorization was even approved for other type of NBFCs, not just MFIs. And then there were targeted LTROs, and I know I saw the report that many of the impact NBFCs were not the beneficial of the TLTROs, and I'll come to that forward. So in RBI's balance or RBI's categorization, there wasn't a subclassification of what you call impact NBFCs. If there was something that fell within the category of impact NBFCs which had a separate category, that was only MFIs. Otherwise, it was based on what is called whether they are deposit taking. If they're non-deposit taking, whether they are systemically important or not important. Earlier, it was 100 crores, it became 500 crores. And now the latest scale-based approach has 1,000 crores and 15,000 about those. So the idea is that the regulatory framework is moving towards absolutely scale-based framework and activity-based within that rather than entity-based. In fact, even if you look at the latest draft on MFI regulation, there is a move to make that into an activity rather than an entity-based regulation. So, which again will kind of harmonize the framework for whoever is into the MFI lending, whoever is lending to a borrower who comes within the category of a microfinance borrower. So it is actually in this context that we need to look at how exactly the impact NBFCs will can be supported going forward, and what does that mean? Does that mean, for example, I saw the report mentioning that we need to create a separate category, separate regulatory category for the impact NBFCs. I come from the regulatory background. I'm not too sure that it fits into the general regulatory scheme of things, number one. Number two, it does not fit into the approach that RBI has adopted, and I would say rightly so, of reducing entity-based regulation and moving towards activity-based regulation. Then we must look at, for example, what factors are inhibiting the scaling up of some of the impact NBFCs. Another interesting question that we need to look at is that will this cease to be impact NBFCs when they become large? So at what stage the larger NBFCs will start targeting the non-impact borrowers more? So just coming back, for example, to the small finance banks, the regulatory framework required them to have 50% of the loan book at sub 2.5 million ticket size, 75% priority sector, and remaining 25% of freedom. But what we see there is many of those NBFCs which we are saying had the MFI pedigree. Okay, they are the average loan size is going up. So as the size of the entity goes up, the loan size or the individual ticket size also tries to move off. Okay, and then there are when they have the larger kind of borrowers to lend to, will they still conform to be lending to the smaller borrowers where they could make impact? So as we see in the report, many of these impact NBFCs are lending to first-time credit borrowers, like maybe MFIs. So they have an important role of bringing those from the informal sector to the formal sector. No two ways about it. But is there an ideal size at which the impact NBFC ceases to be an impact NBFC in the sense it is in the sector? That's something we have actually debate, and that is where the issue of regulation, which is activity based, comes in context. Okay. So now, having said therefore, other ways that we can support the regulator or the system can support, because let's be very clear that normally whether the financial sector regulation should be tailored to meet socio-economic objectives? Is that something that one needs to push? Of course, RBI has a very large mandate, including financial inclusion, social, economic development, rural development, etc. And it has vast powers under BR Act and RBI Act issue directions. But we must also be cautious about taking this as far as to say that the regulation should financial sector regulation per se should be tailored towards socio-economic objectives beyond what is being done today. So when we look at, having said that, if you look at what did the RBI do during difficult times when the sector was going through difficulties, it restored, as I said, periodicity lending tag for loans to other than MFIs as well. Those were used for on lending to specific sectors that were identified by RBI. There were the targeted long-term repo operations which were meant to push money to the NBFCs, and these were done in terms of three particular factors. Number one, of course, as I said, the the episode of one of the larger NBFCs basically getting into trouble. There was difficulty for many of the NBFCs to get access to money funds. Number two was that the pandemic meant that liquidity was required, and these people were the ones that push that money. And third, that segment also had to get access to funds, credit at relatively reasonable prices. So these three were the factors on which that kind of made RBI to bring those liquidity instruments in place. And I do see from the report that many of these got the NBFCs that got benefit of this were the relatively larger ones, and the smaller Impact NBFCs were not those which got benefit of this. So one of the things that I believe we must do, in terms of where we go forward, is that it may be wrong, the perception may be wrong, but there is also a feeling that the smaller sized NBFCs are more vulnerable, number one. Two, they could be cutting corners on governance, compliance, risk management. And therefore, I thought one of the things that we need to do going forward, even as an agenda for IIC, I would say, is to kind of look at survey and report on what is the kind of governance, compliance, and risk management framework some of the smaller of these Impact NBFCs are following and adopting in their organizations, to kind of tell the banking system, the potential lenders, the potential the market from where these people could raise funds, to say that the smallness of the size is not in any manner undermining the safety and security of the funds that they will lend to them, because the processes in that entity are as robust and strong as any other. So maybe this is an important point, if you ask me, that one needs to kind of ensure going forward that they have it, and it is portrayed by an independent, or even if it is not so independent entity, like Impact IIC or some others can survey this and provide that information. And ideally, what will happen is, while the banks also would want to lend to a few large borrowers, if they want to diversify the portfolio, a large number of relatively small borrowers might also be of use to them. So, but it's an important element that one needs to say, that the smallness of the size isn't in any manner undercutting the quality of governance, because I think that is where the most important worry that the potential lenders will have. Now, the second thing I believe that we need to kind of look at going forward, and where there is potential for the Impact NBFCs to raise resources at a relatively the cost is, I think now that the securitization framework has come, I think the NBFCs, the Impact NBFCs should use the securitization framework as the mode of originate and sell assets to potential investors in the underlying security papers. And I think if you see the report of the working group committee that is set by the RBI, there is this, they say that RBI should encourage securitization rather than direct assignment on a bilateral basis. And maybe that's something that RBI might be willing to do, because that will create a good market. It will be under a framework that's streamlined through a regulatory structure. And that is one area where I believe, rather than in terms of looking at creating another class of NBFCs at the time when the existing classes of NBFCs are being compressed, will be what I think we must do. The next step is, of course, in terms of looking at equity capital. And I think, I'm sure Mr. Ramraj wrote this paper, and it was part of the inclusive finance report of last year, brought by Access Development Organization, where we have articulated the area of...
Sorry, I think we were not able to hear you. So yeah, we just thought that maybe, in case you are struggling then, but I think you're here now. So please continue, sir.
Yeah. I'll complete with a few final comments. So I think we are looking at, we must look at blended finance, one of the thoughts that have been articulated in the paper and inclusive finance report. So, the point I'm trying to make is, let's try to do what one can do internally within the organization or within the NBFC sector, what the investors can do, because my view is that regulatory framework being supporting a particular type of NBFC may not be easily forthcoming. We can obviously make that request. In fact, I saw that even the NBFC lending tag has ended in March 22, and there's a request by the NBFC sector for being continued, and what the RBI will take. But I think that is one thing which possibly can be something that can continue. And since the NBFC sector, the Impact NBFC sector essentially lends to those kind of activities which are eligible for being classified as priority sector for on-lending, maybe that is where the support can come from the regulator. So, in sum, NBFCs play an important role. In fact, NBFCs, as I said, there is no regulatory categorization of Impact NBFCs. So, unless, except for the data that I saw in the report, we don't have a report on this segment of NBFCs except for MFIs. But even for MFIs, the special regulatory treatment, as I see, will cease over a period of time. Scale-based regulation is what will come, and therefore the smaller of the Impact NBFCs which want to grow will have to, somebody has to kind of back for them to say that they are as creditworthy as the large ones, that their size isn't in any manner impacting the quality of the internal governance, compliance, and understanding the process, and therefore there is safe credit risk for banks to lend to them. So I'm sure we have a galaxy of speakers that are there. Solutions have to be found, because I do know that India has a large element of informal sector credit that needs to come to the formal sector, and this Impact NBFCs can play a role in them. But how does the larger regulatory principle that has now been articulated by RBI, will sit with the aspirations, regulatory aspirations that have been articulated in the report, is something that one needs to see. But I feel there's a lot more that the sector or the segment of NBFCs can do internally, and organization like IIC can do to kind of articulate their requirements and their strengths to people who could provide them resources. So let me conclude by saying that the report is very timely, it's very interesting, and there are interesting solutions that need to be found to make these NBFCs help these NBFCs play the pivotal role that they can in furthering the financial inclusion of India. Once again, thank you everyone for patient hearing, and to IIC and Madana for giving me this opportunity to share my